G'day everyone, welcome back to Pete's Investing. Today is May 23rd, 2023. This is the Euro-US dollar currency update. On the weekly, we're broken into a neutral positioning, but on the daily, it's broken down into a bearish signal. So I'll have a look at that, and we'll look at the hourly in a few minutes. First on the weekly, our triple moving average 3, 5 and 60 is still in an uptrend, whereas the CCI 150 moving average 5 and 50 is broken down, and that's giving us a neutral signal, so it's undecided. But you'll notice also the awesome oscillator is also, the histogram's declining, but the moving average is still in an upswing, so a bit of an unknown or uncertain direction at the moment on the weekly. On the daily, however, it's broken into a bearish signal, so primarily short trades based on the daily only if we trade on the lower time frames like the hourly. So first off, before we go to the hourly, let's look at the daily support resistance areas. We've got his support level down here at 95.35. It's way off down near this September 22 low, and this recent highs at resistance at 11076. Now it's touched that resistance and bounced off it a couple of times, and it's bouncing down along this diagonal descending trend line. I'm going to keep these diagonal lines in there for the time being because they usually gravitate back to those lines. You can see there longer term where the tops and bottoms where I've drawn those diagonals. Now the Fibonacci here drawn between that low and that high, the price is actually broken down and just approaching the 61%, which is a critical area. If it breaks below the 61, we're probably going to see further declines. So it's currently sort of hovering around the middle between the 50 and a 61% Fibonacci retracement on the daily. But you'll notice also more clearly the last few days it's been stuck to that lower diagonal line as you can see there. On the hourly chart, okay, zooming out first off, you can see there the pattern and it's gravitating towards that lower diagonal. But more closely, you'll notice here there's a divergence, a bullish divergence on the CCI versus a bearish divergence on the price chart. Now they don't always work out, but when they do, most of the time they work. But so when they do, we want to see the price break above this trend line to this upside, and we also want to see the CCI break to the upside as well for it to work. Otherwise, for it to fail, we need to see both price and CCI break to the downside if this is to fail. But just going back here as an example, what it did back in late April. You can see there was a bearish divergence on the CCI versus a bullish divergence. And the way you exercise that is you draw a channel between that range where those highs and lows are. Let me just drill into that a bit more. And when the price breaks below that channel, that's where you put a target. And now I've got this little rectangle, and that's bouncing off the 61% to the 78%, and it hit that very early on. So as you can see there, it continued to the downside even though it made a bit of a retracement to the upside. So that's how I use these divergences as primarily potential trend reversals or continuations. Now here, well, currently playing out, we're seeing a bullish divergence, so we may see a price bounce to the upside possibly. And again, for this to work, we want to see the price break above this trend or this key resistance area. And for that to work, what you do is you place at any one of these recent highs or to this low, you would place a Fibonacci retracement. So if I put a Fibonacci between, say, that low and that high, if I zoom in, you can see there, and if I draw a rectangle, the initial target area would be that 38% up to the 50%, or even more likely the 61%. So I'm going to keep that in there as a potential target area where the price may bounce up to as a potential retrace. So again, for this to fail, we want to see the CCI and the price break to the downside, especially the CCI break to the downside. So as long as this keeps tracking in a bearish momentum and this keeps tracking in a bullish momentum, we're going to probably see a bounce to the upside. Also up here, I've got a backtest in bearish short positionings only, and that aligns with this decline in the price. So you would have had nice little trades along the way up until this point. You would have averaged down. Again, we don't use stop losses. You would have averaged down there and another average down there. So you can see there that it had a bit of an effect on your profitability had you traded and kept the short positions in there. Now, the way to avoid those drawdowns or those averaging downs is you make sure that you can see there the start of that uptrend you want to check the daily and the weekly. You can see there, if you're going short only, short positions were held during that period on the weekly until that point there that you would have started trading long. Likewise back here, long positions started during that area. So from that point there in December 22, so if you look at, if I zoom in to December 22, you would have, you see there would have been, that was the last number of daily short positionings available, and from there on it started long positions. Likewise from here up until there, you would have had short positioning, some neutral position, and then some long positions from there. So you would have avoided taking those short trades, how you traded according to the weekly and the daily. Hence I always emphasize follow the weekly and daily trends primarily to improve your probability of success. So to understand how to trade this and other trading strategies, reference the links in the description below, where to my Patreon page. We do some weekly scans of stocks, currencies and commodities. Subscribe, like and share the channel. Thanks for watching, and see you in a future video.